Wow, have you guys ever had those days where you are just in the thick of it? That is where I'm at right now. We are in the midst of tax filings and all the things for extensions and all the stragglers, which most of us are in all reality, but here we are. So welcome back to Spicy Takes and Tax Breaks with me, your host, Aubree Denekamp, also known as the Write-Off Queen. Like most of you've probably heard that the IRS is out there auditing people left and right. I mean, that is one of the biggest questions I get on a daily basis. But in the truth, like less than 1% of those returns that are being submitted are getting audited. Yes, it's literally 1% of the population. Let's bring it back to your teenage years. That's like showing up to a club and realizing only 1 out of 100 people are going to be carded and you're less than 21 and maybe have a fake ID or just YOLOing it. But here's the kicker. If you're self-employed, a high earner, or your numbers don't make sense, suddenly you're somehow in that 1% based on mainly calculations. Today's episode isn't meant to scare you. I'm here to literally hand you the damn playbook, the IRS on the rules, ratios. Once you understand them, you'll realize it's not about cheating. It's about structuring it the right way to fit the rules. Today, we're going to talk about the IRS red flags that no one warns you about. We're going to cover the do's, the don'ts, the dirty little secrets on the tax code that could either save you so much money or cost you so many thousands at least. So, without risking landing on the IRS auditor's desk, let's dive into it. Here's something most people don't really realize. The IRS isn't sitting in some back office room going through and being like, hey, here's who we're picking or drawing out of a raffle ticket. So, randomly, what they're doing, it's an algorithm similar to Instagram, Facebook, any of those things. What we see online, the systems are trained to pick up anything that doesn't fit the pattern or isn't suiting that consumer. In this case, the consumer is the IRS. So keep that in mind. So things we want to think about is unreported income. Let's say someone issues you a 1099, a K1, a W-2, investment form, something like that. Maybe you sold some crypto, a property, let's think a truck even. The IRS already has that data in the system if it's reported a 1099, a 1099K, a K1. Any of those type of things are automatically reported to the IRS. So they're not waiting for you to confess anything. Their computers match things. They go through the numbers that are submitted, the numbers you submit, and then they also go through everything that shows as a red flag. Say you make $100,000 in income, but you spend $85,000 in travel, and then have huge office expenses here in the US and nothing else matches up to make sense for your business. That would be a red flag. And if it doesn't line up, you're getting a letter in the mail. You can't play the never got the card, like didn't show up in the mail, check never came. It doesn't really work like that. They don't care. So one of the big things I'm here to teach you today is where it gets interesting. So expenses that don't line up with your income, or if income is never actually generating a profit year after year, exceeding 3 to 8 years, depending on what it is you're doing with other things. Imagine you're reporting 40K in revenue, but somehow 49,000 in expenses are coming year after year after year. The IRS knows you're not surviving on negative money if there's no other income coming in any other investment or in any other income, job, W-2, 1099, other companies you're invested in. You're not surviving that way. You're not being able to cover your groceries, your fuel, it just doesn't make sense. So an algorithm is in place. Basically, think a spreadsheet pointing red flags. And this is where people get nervous. People are like, okay, repeated losses, that's okay. I've heard that's great. I watch YouTube and that's amazing. TikTok tells me all the time. But the hobby loss rule comes into play. So the IRS can step in and say, hey, maybe it isn't a business anymore. Maybe it's just a side hobby. And if that's the case, there's really not any more deductions. And those deductions you've already taken are going to be taken back. And you will now owe taxes on those. Again, if you are working in a strategic way, that's different, but also something to consider. Here's where I want you to breathe. Most of the time, they don't automatically slam the hammer down and say, hey, no. I'll give you an example. I had a client, let's call him David. He ran a startup travel business, 6 years in a row, losses, not small ones either. We're talking six-figure and very in the red some years. On paper, it looked like a total hobby. He was hoping for retreats in Bali, renting villas, flying groups out, but never quite turning any sort of corner on business growth or what was going on, assets being purchased. They let it stand though, losses and all. That's why I tell people don't panic if you're not profitable yet. The IRS doesn't want numbers. They want to see some other money coming in. Again, David, he had other income coming in. He had investments, he had other capital gains. He also was very big into real estate and flipping homes at the time. So there were other things coming in. So his algorithm was never red flagged, even just from that point. So you can survive 6 straight years of losses in a big way and still come out fully clean. It just matters how you're structuring it. Here's the thing about the IRS. They really don't care about how creative you are. They care about how well you can back it up. Similar to if you have a cheating boyfriend and you want to go and say, hey, what are you doing? You typically want to come with receipts or some sort of proof. Similar with the IRS, that's what they're looking for. So make sure to document every single thing you can. If you can't prove it in some capacity, you're typically screwed. So that vacation you took, once you're in an audit, if you can't back it up with why you were there, when you were there, some sort of calendar agenda, email, Outlook, bank statements, receipts proving it, you're typically screwed in that situation. So always be sure to use an accountable plan. In my opinion, this one is criminally underused. I have clients come to me all the time and they are thinking they had a great CPA because they've never been audited. And none of these things were ever being deducted, not even talking about home offices or getting creative in what we can do there, but just in a standard way of what is being expensed and how you're documenting it. It's just not being taken at all, regardless if it's being ran through your business expenses or on your P&L or not. So your business can reimburse you tax-free for your mileage, vehicle expenses, home office, internet, phone, things like that, based on how you're structured. So all of those little things that you're probably just absorbing, the shoes you had to buy for a certain job or a blazer for a certain photo shoot, those can all be deducted if you're doing it in a correct structuring. So I want you guys to keep that in mind when you move forward. I had a client, a real estate agent, he wasn't doing this. He was paying for everything personally, leaving tens of thousands on the table year after year. Once we set up this accountable plan personally, he was reimbursing himself between $18,000 and $22,000 per year just by the accountable plan, not anything else we were structuring into it. And that's fully tax-free. So you're deducting it from your business, but you're also not having to absorb any of it from your purse. So big things here. If you're an S Corp, do you pay yourself a reasonable salary? If you're not, you should be. Let's get into that. We have a free calculator. Feel free to download it. But don't be genius running $300,000 through your S Corp as a net profit while reporting a $2,000 salary. That's just not going to work. The IRS will flag that faster than you can say audit. But here's the nuance. Reasonable doesn't mean crippling by any means. It just means what someone else in your role would get paid if you're not over a certain threshold for net profit already. That's what you should be paying yourself. And we can get creative here too. I worked with a marketing consultant pulling, I think it was about like 280, but let's call it 250 for round numbers. And I think we set her salary at 50 to 65K. So her salary wasn't 200K, 250K, 275K like a distribution would hold here. Perfectly reasonable though for what her job description was. She saved more than $35,000 in self-employment taxes that year. That's huge. I know all of you want to do like ourselves a favor and not pay the IRS, but we do want to do this correctly. So a lot of people hate me for this, but you should be investing in bookkeeping, whether that is someone in-house, whether you're doing it yourself and having someone review it, whatever that looks like. It is that pillar person who's going to make such a difference. Quarterly through a CPA even would work, but you want someone looking at this so they're advising you what actually you're spending through your company is deductible versus what is completely not deductible. Because at the end of the day, when that is handed in, we as a filer have to do what is compliant. And a lot of that lands in a distribution to you. So I can't tell you how many business owners try to manage this and they do it fully incorrectly. So whether that is themselves as the business owner in-house, having someone doing it outsourced, hiring even a bookkeeping company to do it, they come to me with huge negative assets of, let's call it $100,000 or more on their balance sheet. And they have no idea anything is even wrong. And the great thing about that is trusting your people. But the bad thing about that is there's no damn way Chase is going to give you $50,000 in a negative and let you continue using that checking account. It's just not going to happen. So if you're not investing in any sort of bookkeeping, planning, prepping, whether that is in yourself, whether that's time you're investing, whether that is with paying someone in-house, whether that is paying someone outsourced, hiring a firm, working with a CPA to do that more than just annually for filing, it is a mistake in my opinion. The IRS is trained. Think about what AI and ChatGPT alone can do. But if we go beyond that, we are looking at huge things in the sense of what is built in every single algorithm and every single industry standard already. And Google could tell you that. But the ratios, the averages, the numbers that they expect to see on your return, even based on your prior year returns, those are just standard. They're built within the system already. So those are going to flag based on what you're doing. Again, the number is less than 1%. But here's the deal. If you're, let's say, a realtor and you're trying to claim that 60% of your income that went to meals and entertainment, you're probably out of alignment here. The IRS doesn't even have to prove you wrong. You're just not making sense within your business anymore. The number flags you before a human even ever is going to take a look at that return. So that's important to remember when you're working with any sort of advisor or filer. I've had clients making about $290K in profit who wanted to deduct literally every single meal they ate, breakfast, lunch, dinner, home, groceries included. If food hit the table, it was on their books. On paper, that came out to almost $120,000 in meals for the year. And that's impressive, even for someone like me who enjoys to eat out. But think about it. To the IRS, that looks more like a business development, more like someone who's trying to use their profit margins way versus actually using that as a business deduction and doing it in a business sense, which again, as a reminder, business meals means you and one other person, whether they work in your company or a client, prospective client, or just someone else that you're talking to about business, that count as a business meal. Only 50% of that is actually counted as a business deduction when it comes time to file your taxes. So here's what we do. We cut back to very legitimate expenses. That can vary based on how you're doing it, whether it is doing events, you have a lot of team meetings. There are different ways to classify things, which, like I said before, a good bookkeeper can make or break you no matter what you're doing. But if you are, for example, a realtor, like I said, we'll continue on that example, and you have confirmed via calendar any sort of appointment, whether that's with the client or you just throw it on your own calendar, you can just put what was discussed or have an average idea if an audit ever comes. And that's basically all you need. So the result is the IRS doesn't blink at that. That's okay. The difference between an aggressive and a sloppy return or an aggressive or sloppy type of filing or recording makes all the difference. So it's not a loophole, it's a rule. Think about that. So ask yourself, do your numbers line up in your business with your industry? Do they line up with your other income sources? If the IRS pulled up your return today, would it look like their business playing smart or business trying to game the system? It's really the question that you should be thinking about before you file every year. But better yet, while you're trying to actually strategize of what makes sense to spend your money on throughout the year. Document it. If you go to Vegas for a week and spend one day seeing prospective clients, that's great. Write off the whole trip, that's awesome. The IRS auditors are going to be less than amused by you spending time in a strip club and writing it off. But if you're actually doing business, which go check out our other podcast about actually what counts as business travel, and you'll know the deals, but it absolutely can still be deductible. Don't pay family under the table. Hiring your kids is brilliant. You should absolutely do this. But take a look at what you're paying them. Do they need to be on payroll? Are they a W-2? Should they have a 1099? Are you within thresholds each year, which right now we're about 15,000 just over. So your 5-year-old absolutely should be working for you. My 4-year-old is working for me for several of my businesses. But are they a model? Are you calling them a CFO? Like, there's different titles on what you should be doing. Again, check out the other podcast for all the do's and don'ts. Also, do not ever ignore your state filings. Make sure these are matching up. It's important. So focus so hard on federal, most people do. But what you're missing is they do align to the state. So you can be using Arizona TPT, California BOE, or having to do franchise taxes. They're often way nastier and way more on top of coming after you with your fines, with anything that you are due, than even the IRS and the federal side is going to be. So make sure we're taking a look at this and you're communicating that to who's filing your taxes, or you understand what that means if you're filing your own. I recently had a client come to me, and thankfully they were very small and new into business. But they had skipped a couple of TPT filings thinking it's not a big deal. It's just $2,500 here and there. But by the time the state was done tacking on penalties, interest, late fines, it was over 19,000. States do not play around most of the time. So don't overcomplicate things here. If you don't know, ChatGPT is great for so many things. Trust me, I use it in my daily life too. But make sure you're sourcing it correctly or knowing how to fact check that after you're using it. It's important. Also vehicle deductions. They're one of the easiest wins for every single business owner, LLC owner, sole proprietorship, hobby, side gig person, whatever you want to call it. But one of the things here is if the business is not being used for 100%, you want to make sure to document that correctly if there's nothing else that you can back up in an audit. But if a vehicle is being used 100% and it's documented, it's 100% rock solid and should be 100% a deduction. So even if it's mixed use, part business, part personal, you can deduct the business portion as long as you're tracking it in some capacity. So really what the IRS wants to know is what the total mileage from the vehicle was, what the total business portion was in mileage, and then whatever expenses there were. So whether that is car washes, registration, insurance, payments on the car, interest on the car, if you're leasing the car, what those payments are, fuel, any of that, wheel changes, tires, all of those things we want to be tracking in some capacity so we know what deduction makes most sense, whether it's a mileage deduction or whether we're going to go more forward into just actually taking those expenses based on what that mileage percentage is in those expenses. So again, any filer will be able to tell you that. Even a simple system like TurboTax, you can run it both ways most of the time. It's typically you have to request to do that, not in an actual hard way, but you have to push a button to say, I want to see the comparison. Otherwise, it does typically, I think, default to mileage. It's been a very long time, though, since I've used that. So keep those things in mind when you're doing it, whether it's do it yourself or not. You should be taking advantage because either way, no matter who is filing your taxes, these rules are the exact same. I had another client recently in construction. He nailed this. He bought a truck, wrapped it with his logo, tracked every mileage, and we run off the business percentage without a hitch. There was no questions, no red flags, 100% business. He even went the extra mile and put it in the business name when doing so. But similar to that, the IRS really doesn't say, don't deduct ever. They're saying, show me how you did the math here. Why does this work? Why is this fitting within the rules that we gave you? So another tip here, don't misclassify workers. This is one of the fastest ways to get yourself wrecked in an audit. A lot of business owners think I'll just call them a contractor. I don't have to deal with payroll taxes, payroll processing fees. benefits, HR headings, unemployment, any of the things that might come with that. But the IRS and state labor boards don't really play games here. Here's the rule of thumb. The IRS controls and determines the classifications. So do the states. So if you control what work is done and how it's done, that's an employee. If they're driving your vehicle, that's an employee. If someone brings their own tools, sets their own hours, takes on multiple clients, and controls how the work is being performed, that's a contractor. There are gray zones here, though. So if you're in doubt, assume the IRS will lean towards an employee. Why? Because employees mean more payroll taxes collected, whether that is for the state, whether that is for federal, but it's also easier to track. So again, keep this in mind as you're moving forward with things. I want you to have a really good idea because you can do this however you want as long as you're documenting it. I get so many questions regarding the things no one is telling you forthright. Things I wish I would have known starting out. We'll get into it now. IRS doesn't want perfection. They want compliance. It's really the biggest deal. If you mess something up and have solid records, they usually adjust and move on. When you've got nothing, no receipts, no logos, no explanation, you're pretty much toast. You have to pay them money regardless if you believe it's justified or not. Second, the tax code was never written for employees. Employees get scraps, honestly. Business owners get deductions, depreciation, cost segregation. They get the Augusta rule, income shifting. They can set up different multi-entities. That's why your neighbor with rentals and an LLC pay less taxes than you do as a 6-7 figure W-2 earner typically. Third, audits are algorithms. Like I said before, certain ratios, codes, patterns flag you. Like a client of mine who wrote off 90% of meals. Again, bad idea. It wasn't that the IRS was mad, it doesn't matter. It was that the code tripped the system. So some human then looked at it or another computer did. Once we reclassify and documented, the flags disappear completely. Fourth, you can negotiate pretty much anything, similar to sales. Payment plans, penalties, abatements, even offers and compromise. I helped a client settle over $75,000 in debt for $18,000. Not because the IRS is nice, not because they were feeling generous that day, honestly, but because the system is designed to collect something rather than nothing. So lastly, wealthy people aren't cheating the system. I can't say this enough. It's one of my biggest things I'll continue to preach on this podcast, but they're structuring it better. They know the rules. They have someone who knows the rules advising them, whatever that looks like. They know what to do and it's written to do it. The only difference between you and them is access. Make sure to have someone look online, watch YouTube's, podcasts, shorts, any of that stuff. It's giving you the access for free most of the time anymore. Here's the bottom line. The IRS isn't boogeyman. They're not here to come get you, but they're also not going to be your best friend. So make sure you're doing it correctly. Document your expenses. Know when you're being strategic versus sloppy or potentially an audit trigger. Make sure you're asking someone or looking at what the calculations or percentage differences are year after year for the business. Stop apologizing for using the tax code for the way it was literally written to be used. People who are educated, the ultra wealthy, industry leaders have all been doing it for forever. It's your turn if you're not already. Remember to follow along for more tax breaks and how-tos. Next week, we're going all into how we're going to make more money for you, but more so turning into what you are paying in taxes already into strategies for wealth. Thanks for tuning in. I look forward to seeing you next week.